Hey everybody, this is Jose Blasco. We are about to get started in just a few seconds. As always, as we are getting ready to get started, it's always good to have confirmation from you that the sound is good. A quick message on the chat box is normally what we do, isn't it? A quick hello. It's a nice way to start the session and it tells me that you hear me well, so all is ready to get started. So please go ahead and do that. Type a quick hello on the chat box. And that way we start on time. The session is right now reaching the top of the hour, so it's time to begin. So let's begin. Welcome to the session, everybody. This is Jose Blasco. Today is May-19, 2022, and this is Options with Options. This is the live sessions that we run where we are looking at the options markets. And we basically adapt to the market conditions. One of the things that we love about options is that, as I always say, options give you options, and that obviously is very useful when market conditions change, which is happening in a regular basis. So we get into premium seller mode, premium buyer mode, non-directional trading, directional trading, whatever it is that makes more sense given the market conditions, and that's what we do in this type of sessions. Before we begin, I would like to highlight the disclaimer on the upper left side of the screen. So please read it carefully. This is important information. It's, as I always say, fairly short, and that means that I guess it's fair for me to request that you read it completely. I'm indeed counting on you to do that because, again, it's important stuff, and what we do here is serious stuff. We are trading. That's not a joke, and therefore I'm sure you guys are looking at this seriously. Christian, thank you so much for your message. How are you, my friend? And Jeff, you too. How are you? Thank you for the messages on the chat box. This is very nice. Cool. So let's go for it. Agenda for today, we're going to be looking at the market, review the trades, and look for new opportunities. We have a lot to talk about today, given the very violent movements in the markets that happened in prior days. Therefore, we have certainly some important conversations to have. Mark, how are you, my friend? Good to see you. Before we get started, super quick, the questions page. So you will want to go to tradewithufos.com/Jose. And the moment you get into that URL, that will bring you to the questions page where you could scroll down. You can find here the section for app subscriptions in case you haven't done it yet. Here's where you find it. And just a bit lower, you have any questions. That's where you find your answers by either typing what is it that you're looking for, or if the answers are not available because no one asked that question before. So then you can always click on the green button, ask a question, and be the one who phrases the question, and we'll have our support team reply. Having said that, this section of the website is interactive for everybody as long as you are logged in. So you guys feel free to also interact on posts from other traders, other members of the community. Okay, that's certainly a nice one. So going back to the charts, and that way we can start our sessions. Today, just because it's a very simple analysis, the one we're going to do here with the VIX, I would like to start with the VIX, which is obviously high. It's currently trading at 31. Notice how the VIX had a significant drop in the prior week to now just come back again to a pretty high level in the 30 plus mark. Okay, so what does that tell us? Well, that tells us that initially the favorite or perfect approach would be to be a seller of premium, but again, that normally goes very, very well in cases where you don't plan to be directional, where today actually we may plan to be directional, as you will see as I analyze the S&P in a moment, and therefore I'll come back to talking about the VIX a bit later. For now, let's keep in mind the VIX is trading at 30 plus, which is obviously not a low value. The VIX is high, and therefore we expect the majority of stocks in the US to provide options prices which are not that crazily inflated, but certainly with some nice premium built in many cases, not in all cases. Take a look at, before I continue with the S&P and I look at the proper analysis of the S&P, let me continue a bit more with the implied volatility. So take a look at the probability cone on the S&P, where the red line, it's indeed beyond two of the blue lines, but the lighter blue line, which represents the 1 month historical volatility, is way past the red line. And this has to do with the very, very violent moves that we have seen recently. Like, for example, yesterday, the S&P in a one day had a move to the downside of around 4+%. So 4% move in one day for a large market like the S&P, it's indeed very high volatility. This happened in less than a month, and that's why the light blue value, the light blue blue line, it's away from the other blue lines, because the other blue lines are measuring the 2-month and the 3 months historical volatility, which are less exaggerated compared to the 1 month. So take a look at that, and therefore now what's the reading? Well, now I guess you understand why I said that the VIX is high, but not that high. 30 plus is definitely not a low value, and we may find many good cases where to sell premium. But at the same time, compared to the speed of movement the market could actually produce, actually options are not that expensive. If that was the case, the red line would be beyond the light blue line, and that's not the case. Okay, so let's look at things in the right context, because if we looked at this couple of days ago before the crazy move, so then we had multiple of these blue lines beyond the red line. Okay, but now what happens is that, let me grab the right line. Here we go. So now what happens is that with a crazy drop yesterday, so obviously the red line went past the two blue lines below, but still not the 1 month historic volatility value. Okay, so let's keep that in mind. The market has potential to move very fast, faster than what is expected based on the prices of options. That's basically what I'm saying, and therefore the prices are not that exaggerated when it comes to inflation. Okay, let's keep that in mind. Now, going back to technicals and looking at the market, so what we had is actually the same thing, the very same thing that happened a few weeks ago, where we had just a few little tiny blue dots that were not even thick, they were thin. And then we had a very powerful climate to the downside. And then we had the same thing, very tiny, shy change from red to blue, and then a very powerful climate to the downside. Well, guess what? We are back to the same scenario, where the market is also, again, one more time, producing this type of pattern. And what I was mentioning last week when we met on Thursday is that if this blue was to show more evidence, and at the same time, evidence meaning confirmed climate, thick dots instead of thin, and on top of that, we were to see that the gray line is now below the blue line, or another way to say that is that the blue line is now above the gray line, meaning that in the options arena, in the options markets, we can see options data suggesting there are buyers available. So then I would have switched from a very careful mode to a very bullish mode. But the reality is that right now my mode is quite bearish, because not only we have a confirmed climate to the downside, which is just starting today, on top of that, the implied volatility for the puts is greater than the implied volatility for the calls, okay? Gray above the blue. Therefore, all of this is a very bearish sentiment that we can read from both price movement and market data from the point of view of candlesticks, if you wish, or price action. But we can also get the same feel, the same vibe, the same sentiment when looking at options data. And that may actually mean that we are actually in the first wave of a very, very, very strong push to the downside, which may continue, throughout maybe a whole year, additional whole year, or whatever it is. I mean, as traders, to be honest, that doesn't matter too much. We're just going to trade whatever direction is given to us. Of course, for those long-term investors, and that may be some of you, maybe today live or watching this recorded, well, careful, I would say, because market data is telling us that the market condition is changing, definitely, and we can see that, while the blue climates used to be 7, 8, and the red climate used to be 2, so now the red climate happens to be 3, and the blue that was 7, 8 now is 6, and on top of that we see a lot of invalidations of this duration of 3, and the duration is much more. So again, all of this is telling us that the market is really pushing very, very, very hard to the downside. Not sure why. You could maybe blame it on the Fed, on the changes of interest rates. I mean, it doesn't matter, to be honest. The reality is that that's what's happening in the market, and that's what we need to trade. We need to trade the evidence of what's happening. The reason why it's happening is interesting for the conversations, but doesn't help our trades, isn't it? So anyway, so going back to this market analysis, what else do we have? Well, in the 55-minute time frame, there is no sign of green UFO. It's all red UFOs. What's available? On the daily time frame, there are green UFOs, but they are way lower in price. Okay. When we look at the volume map, I mean, it's a bit too soon to consult this on the day. To be honest, on the shortest expiration date, we both on the call and the put side surpassed the average volumes. Okay, but it's 1.3 times more, 1.7 times more in the favor of the puts. Implied volatility to that real time is equal 28.28. Okay, so right now this is not telling us too much, and not too surprised if you look at the current candlestick formation is the perfect kind of like indecision candle. So obviously we can read some indecision in other places. Okay, but again, when we look at the overall condition, and that's why I'm using auto climate above, and I'm using a 3-day moving average of the implied volatility below. I'm using a 3-day, so I get a more complete feel of what's happening overall instead of only today. Because today what may be happening is just a lot of profit taking from all those shorts, okay? And that's why we see this indecision candle, which more than indecision may simply represent a pause for then a continuation of the move to the downside. So yeah, so it's not so relevant to look at the 2-day implied volatility. It's more interesting from that angle to look at the implied volatility as a 3-day average, as I'm doing, okay? But yeah, anyway, going to the 2-day time frame, again, the green UFOs are very far down. Going to the 3-day time frame, so the green UFOs are much further down. Okay, so the only good news here is that we are inside of a speed bump, which I plotted here a bit earlier today. We know those speed bumps are often the origin of relevant turning points, but notice how, as the price tried to go higher, gapped up inside the red UFO, and then that was the crash yesterday, 4%. So yeah, again, we may have unfilled orders come in, but we don't see them yet. They haven't got into the market yet, and if everything remains as it is, really, well, I even changed the background color behind me to be red. So in case it's not clear enough, you understand the sentiment when doing the market analysis. Okay, again, the fact that what I just explained here is opening the door for bearish opportunities to short markets, etc., doesn't mean I feel the world is ending or it's a bad thing. It's just a normal market condition. And by the way, if let's say the only thing you trade is equities, yeah, for sure. Probably you are used for many years of being a buyer and very few cases of being a short seller, because the markets have been in a bull run for such a long time, like crazy. So maybe you're very used to that. But if you trade other markets, if you trade commodities, if you trade currencies, if you trade whatever, so I mean, you had during these past years, you had so many opportunities to trade just as much to the long side than to the short side. So to be honest, I'm just having fun with changing the background color of my virtual background behind me more than anything else. Okay, I don't mean to scare anyone. And if you're new to these sessions, okay, just make sure that maybe it's not the best sense of humor ever, but I'm just trying to kind of be a little humorous and be in tune with the market at the same time. Okay, so anyway, so what's the plan for today? Well, since the market is basically lining up for move to the downside to be produced, then one action I would like to explore in our market research today will be to look for shorting opportunities. Okay, and today I'm going to plan to be directional. Of course, we know that the best way to be directional is to do debit strategies. Christian, you're funny. Joanne, good to see you. Good to see you. So, I was saying that the ideal way to be directional is to use debit strategies. Okay, when options are very cheap, you get those debit strategies. You get plenty of deltas. Those deltas are very cheap, right? And if the move takes place, the gamma accelerate delta is beautiful, right? What's the issue? Well, the issue is that premiums are not that low. They are not that high, but they are not that low in many cases. Of course, when we do our scanning, we will try to find stocks with low implied volatility, which probably will be difficult to find. So very likely we're going to be spreading, we're going to be maybe butterflying to try to mitigate the impact of implied volatility moving against us, if that was to be the case. So we will do that later when we look for the opportunities. But certainly, I want negative deltas. That's my main goal today. And that's what I'm going to try to find as we are done with the market review, with the trade reviews. For sure, let's say you already got a few shorts that you got in, let's say, for example, yesterday or the week before, and you already got some shorts in your account. Obviously, adding more shorts just because the market condition is confirming itself, kind of like proving itself to be bearish. Well, that doesn't mean that you need to keep adding more shorts, because then you would have too many negative deltas. And remember, risk management is not only about managing the risk per trade, it's also about managing the portfolio risk. So maybe you cannot afford shorts. Well, if you cannot afford shorts because you have too many short deltas already in your account, then this is a good environment as well to do non-directional trading. Premiums are fairly high. You can find good setups like we did last week, and that could be a very good, very valid approach to the trades. Okay, so keep that in mind. But again, my approach will be to look for directional opportunities, and then I'll talk about it from two angles: directional opportunities if you don't have shorts, and also directional opportunities if you have too many longs and you need to urgently hedge that. Okay, so we'll talk about from those two angles. Market review. So we have a few trades here going on. So the one with Verizon, okay, this was a bullish trade that we entered. I think I kind of like reviewed a lot of this trade on the last Thursday, so I'll try to keep it very short. But the bottom line is that this trade has not been working well for obvious reasons. We got long in a market scenario where the market has been pushing down like crazy. Yesterday, 4+% in the S&P. That's really not a joke as a move. But guess what? While all of this is happening, this stock, it's trying to fight it back. Okay, and we are basically, we got two opportunities, okay, on that date, which was last week, and this date, and this date, and this date, which was 3 times this week, actually last week and this week, where we went back to be above or equal or above our entry point, and therefore some actions could have been done to not only to basically exit this trade, at break even, or remove risk by buying back the puts. Here we go, Mark. Wonderful. I love it. I love it. You've been on top of it and you acted. Wonderful. Love it. Thanks for sharing that, Mark. You bought back the put spread. So exactly. In my case, I'm just a little bit unlucky, if you wish, in the sense of, I love to do the executions in front of you guys when it's the right time, because that way you see how it's done. So then when you have to do it by yourself, you know how to do it. But last week I was a bit unlucky because I think Thursday was that day, and the day before is when it was time to do it, and we were meeting the next day. Okay, and then guess what? Today is here, and yesterday was the day where it was ideal to do it. So I missed it in both cases, and that's why the P&L of the Verizon trade here is showing -19. Okay, because of that reason. Now, if you think about it, the strategy is working beautifully, because such a move against us that we had, etc. In the end, this particular trade is not suffering too much. $19 of loss, that's nothing. One of the key elements in this trade, which I mentioned last week as well, is the fact that Verizon is a stock that belongs to a strong sector. Remember, my friends, this is an important lesson to always remember. Stocks are beautiful to trade, but they are a fragile asset. Okay, it's like if you have this beautiful porcelain statue at home, it's beautiful to watch, but if it falls on the floor, it breaks for sure. It's fragile. And it doesn't mean it's not nice to have, because it's fragile. It's nice to have, but you gotta be careful. And the way we deal with stocks is that we are always looking for setups where, if we're gonna be long, we want those stocks to belong to strong stocks or to strong sectors or groups. If we're gonna be short, we want the opposite. We want those stocks to belong to weak groups. Why? Because if the overall market was to fail us, like it happened, hopefully the sector kind of holds that stock, so the stock is not killed, or vice versa if you short. Okay, and this is a good example of that. A trade that obviously didn't do what was expected. We wanted to ride the move all the way to 52, and definitely it has not expected. It has not happened. But certainly, if you look at what the S&P has done, which continued falling, and you look at what the Verizon has done, so I guess it's a good lesson to be learned. So I'm not going to touch it. I'm going to leave it the way it is, because if I act now, I'm basically exiting the trade for a loss of $19, which is nothing, but it's not too interesting to me. I rather, again, if you are conservative with the trade, if you understand what I said before, that my view of the market is bearish at the moment. So obviously, I'd rather not be in this trade. But at the same time, I'll leave it open. So if the trade gets in trouble, we'll talk about things that we can do. And if the trade then progresses, then we'll talk about, what is it that we can do in a case which is the normal case that you would expect when you get into this trade if all works according to plan. So I'm going to leave it alone. But Mark, again, very well done by you acting on those puts, because now basically by doing that you have removed the risk of the trade, either in its entirety or plenty of it, and now you are left with a position where you basically not having risk. It's a very comfortable position in which to be, and if the stock moves, then you're gonna add a profit. Okay, one suggestion I would say here, just for you to think about it, Mark, and you can do the homework and the exercise yourself, which is, if you got rid of your puts below, that means that you are left with a long call. So something that you could do is to consider to sell a call against the call you own. Okay? And instead of owning a long call, just do a call spread, because that will reduce the cost of the call you currently have. And therefore, if the market was to never rally, so instead of having this kind of break-even or very low result type of trade, well, you would just add a little bit more juice. It's not going to be too much, obviously. It's a low price stock, and it's quite far away from where the target that we wanted. So it's not going to be too much, but that's something that you could consider checking, and maybe it could help. Yesterday would have been better, because having the stock higher would make that call higher price, and therefore you could sell. Not only you can close the puts at a better price, but you can also sell a call against the call you own at a higher price too. Anyway, so that's Verizon. And the other trade that we have, which is non-directional, which has been beaten like crazy, is Lulu. Okay, and this one, well, we're gonna comment on this quickly. I want to spend a little bit more time and detail to discuss. Okay, because last week when we met on Thursday, it was that day, if I'm not mistaken, or maybe that was Wednesday, I'm not sure now, but I remember saying that price action crossed the purple line, and therefore it was time to butterfly it. Okay, now I did not do it because at that moment price was quite above the purple line during the intraday session, and it was not making sense to do it at that time. But I mean, if you have been watching this right at the open, you would have butterflied it. Okay. Now, prior to butterflying, if you recall, I draw this red line and I draw this red line, which represent that we had two conditions met for us to roll the trade down, which is something that I could not do because we were not meeting on that day, but I did simulate it. And when I simulated it, so basically, here is the outcome. By not rolling, the net P&L of the trade would be negative 221.5. By rolling the first time, the P&L became 182. By rolling the second time, the P&L became 166. Okay, these are my estimations after doing the exercise using historical data, as I showed you, since I was not able to, do the rolls in person because we were not meeting those days. We normally meet on the Wednesdays and the Thursdays, so I was not able to do it. So then I showed you last week how to emulate this type of action using historical data on top, which I did myself after the session, and here you can see the results. So you can see the effect of the roll. Now, the one thing I never did is butterfly. Okay, so I did two rolls. Okay, roll number one, taking the calls from above here to above this red line, and then roll number two, taking those calls away and rolling them down. Sorry, I'm saying this wrongly, guys. Sorry, my mistake. Rolling them down first to above this purple line, okay, and then those calls, then taking them out and rolling them down to above the second purple line, not the red line, the purple line. Sorry about that. So that's where the calls are now. Okay, the 345, 350, those are the calls I have now, which are right here above the purple line. So now, if I didn't butterfly on that day, right? So yesterday was the day to butterfly. Okay, because obviously now we are totally outside the range, and obviously, as you can see, the trade is losing 161. Again, not a big deal if you think about it. I mean, the maximum risk of this trade when we started was close to $500 per contract. Next thing you know, the stock got crushed. It totally did not do what was expected based on the probability cone, based on the UFO. Nothing, right? Absolutely lack of behavior for that stock, okay? And next thing you know, we took a $500+ risk to drop it to 160 something. Pretty nice management. But now, what happens if you butterfly it? Well, currently, we have in this trade, right? So the 350 call long, the 345 call short, and then we have below, we have the 285 put short and the 280 put long. So this is the iron condor we currently have. So butterflying it means that the units above need to be closed. Okay, the units above, they need to be closed. And what we're going to do is sell a unit, a call, lining up with the 285 that we already have. And then, of course, we need to buy some protection above, which obviously $5 strike price increments would bring us up to 290. So basically, butterflying it means rolling the 345 calls to the maximum we can, which is lining up with a short strike. And by doing that, we would acquire plenty of additional premium. Of course, if I'm doing it now, I'm going to do it just so it's demonstrated. But doing it now, which is so low, it's really not going to help the trade too much. Why? Because the lower price goes, the less the calls will pay me, right? And therefore, when I sell the 285 call today, right, I'm going to get paid way less if I sold it yesterday at this price or last week at that price. I would have got paid much more, and therefore the offsetting effect would have been much better, okay? But anyway, I missed all these rolls, all these tweaks, so let's do it. So you see how it's done, even though, you know, again, I don't mind in these sessions. In real trading, I would really bother me. But in these sessions, I don't mind to start the trades at a disadvantage, so you see how it's done, okay? So here is the trade that we currently have. So if I compare spread, and I copy the primary spread, and now not copy, edit. Here we go. And now I edit the spread, okay? And what I'm going to do here is I'm going to add 4 more legs, okay? And it's not like I'm going to add 4 more legs. It's that 2 of the legs I'm going to add is to simulate closing the calls, and 2 of the legs that I'm going to add is to add the 2 new calls, right? So let's do it. I'm going to add at the midpoint 2 calls and 2 more calls. So it's a total of 4 calls, all with the midpoint, meaning all real time, where one is going to be buy, one is going to be sell, one is going to be buy, one is going to be sell. So which one do I buy? Well, I buy the one I sold before, which is 345. So at 345, I buy it. I'm out. Which one do I sell? Well, that's a 350. Okay, the 350 up here was purchased. So for me to exit the 350, I need to sell the 350. Okay, so by doing those 2 actions, I'm out of the calls I currently have in my simulation. And then if I buy the 290 and I sell the 285, notice it's all calls. So now the 285 call is lining up with the 285 put, right? And then I got my 280 put below and my 290 call above, and that's a butterfly. Okay, so again, these screens, when I add 8 rows, let's face it, they look a bit intimidating and probably confusing if you're new to options trading. But if you really think about it, you just need to pay attention to what is in each row. And if you really think about it, it's actually quite simple. I just converted an iron condor into an iron butterfly. Okay. Now, what happens if I do that? Well, if I do that now, I'm taking my maximum risk of 323 to 191. Okay, and I'm still giving the trade a second chance. If the trade ends up between 288 to 281, okay, so which is the upper part of this orange triangle. So if the trade ends up in that range, I will make some money, and it could be up to $309, which is actually more than 177. Okay, now of course, my range now becomes very narrow from 288 to 281, where before it was 346 to 283. So it was a wider range, as we can see very clearly, very visually here, with a green shaded area. But obviously, that's the price to pay to limit the risk. If I had done this yesterday in the middle of the day or last week, I would have got so much more premium for the calls. So, I mean, I would probably still be underwater, but instead of my maximum risk is 191, so maybe your maximum risk was, I don't know, let's call it $100. And you took a trade that had an initial risk of 500, where the stock behaved like crazy nonstop immediately, where you had very little accumulation of time decay, and next thing you know, that initial risk of 500 now is 100. So it's proper trade management to apply these particular actions, even though, of course, if you don't apply them when is the right time, so you had these advantages, which in my case is that my maximum risk is not $100, it's more like 191. Okay, so it's not as ideal, obviously, because I am not doing it at the right time. Okay, so it's critical that you set alerts, you watch those charts, and again, the right time to do it was when price is crossing the bottom purple line. Okay, that was the right time. Anyway, please let me know in the chat box if all of this is understood, and if all of this is understood, actually, I'm just gonna execute it so you see how it's done. Okay, so we are moving the calls, and notice that on my thinkorswim account, the calls I have are still the 400 and 405. I don't have the 345 and the 350 because I never did the tweaks, okay, in the thinkorswim account. But anyway, it doesn't matter. So let's do it. So what you would do is that you would create a rolling order. Okay, you will create a rolling order. So I'm just gonna click on that. And what I'm gonna roll here is basically, I am, instead of rolling the months, which is what the platform would want to do, we are gonna stay with the same expiration date, which is 27th of May. And we are gonna be using 285. Okay, 285 and 290. Okay, this would be the tweak, bringing in $180 of credit in this particular case. Okay, let me see. Understood. An alternative, Christian says, an alternative would be to close the Iron condor immediately when auto climate turned red. I get your point, but remember, when we scanned for the Iron condor, we had two particular parameters on the matrix. Let me bring that up to us. Here we go, which was daily strength to be neutral and weekly strength to be neutral. So in other words, if the auto climate changes a color, which is plotted in a daily time frame, certainly somehow it's bringing in some disadvantage to the trade. But you are also relying on the fact that on a weekly time frame, the level of strength is neutral, and therefore we are relying on that fact as well, expecting the market to, maybe have a little bit of a push in one direction, but for the weekly time frame to be neutral, whatever push you have in one direction on the daily probably is followed by the push of equal strength in the opposite direction, right? So therefore, closing the trade too soon, just because the climate has changed, may basically leave you in a position where now you just locked in a small loss, and it's a small loss, it's not a big deal, but next thing you know, the market came back to somewhere in the range, and you would actually have ended up with a profit. So I'm not a fan of closing an Iron condor ahead of time, because again, you are not giving yourself that second opportunity, which I'm trying to do here. Okay, again, remember the philosophy of these tweaks is always the same. Reduce the risk. So notice how the orange line is higher than the blue line. That's risk reduction. And then leave some area that is still above the zero line. In this case, the triangle shape area under the orange lines, it's what is still our second chance. So because of that philosophy, I'm not a fan of just closing the Iron condor. Again, nothing wrong with your approach, Christian. It's definitely a valid rule. And if this is part of your plan, you just do it and that's it. Done. No problem. But again, I just stated the rationale behind the trade and why, I think it's not that in line with what I was trying to do. But again, we're all different as traders, and what you're saying is definitely valid from many angles. You are managing your risk. You are acting when you feel that thanks to autoclimate you basically deduct that the trade is losing probabilities and you decide to act to get out. So nothing wrong with the whole approach. The only thing is I wanted to remind you that when we started the trade in the first place, we also scanned for strength to be weakly neutral, okay? I hear you, but in these years of market, the moves are violent, aren't they? Yes, but at the same time, here's what happens, Christian. How do you feel about this? Actually, this is Lulu, not the SPY. It doesn't matter. How do you feel about this blue move to the outside? Okay, so when we were talking about this week, that was a pretty bullish market environment. Okay, this would probably have made you feel that even though the autoclimate changes on the stock, it's okay. I'm gonna be cool because the market is very bullish. Well, guess what? As traders, we are wrong many times. So even if we use tools and statistics and predictions and probability cones and projections and simulations, we are wrong many times because the market in the end is unpredictable. The market is going to do its thing, and you never know what's going to happen. No one knew a war in Russia was going to start. A war in Ukraine was going to start. No one. I guess none of us. Someone knew for sure. But anyway, so you get my point, right? So I think that if you overlay on top of your decision process the fact that you are bearish on the market, then to me that is adding a subjective ingredient into the mix. Because while I explained earlier why I am bearish on the market, I even changed my background. The reality is that I could be wrong. Right? So I rather have a set of rules that make me act based on the rules, no matter if in the end, whatever other additional complementary analysis that I have done tells me, blue or red. So that's kind of my approach and just sharing the rationale behind it. Okay. Again, back to you, Christian. Your approach makes a lot of sense. Okay, 100%. Both of the comments you added make a lot of sense. Okay, but this is my view. I get you. I totally get you. Perfect. Okay, so let's continue and let's place the order here. So I'm just gonna confirm and send. Okay, here's the trade with Lulu, which is working. Okay, since I don't want to spend too much time, I'm gonna do the one thing I always tell you, please never do it. Okay, I'm just gonna push it to market just so I get filled, so I can concentrate on finding new trades for the rest of the session. So hopefully I'm gonna get filled now very quickly, and then we can report. Here we go. I just got the prices. So let's expand the fill order panel so we can get the prices. Okay, and the prices that we got were the following prices. So let me bring top on top of TOS. The prices that we got are for the 290 call and the 285 are 510 and 705. Those are the prices that we got. And then, of course, for the 350 and the 345, so then I don't know because I don't have those units to get filled. So I'm going to use the midpoint that we have here, 41 cents and 15. So therefore, if I do a little bit of math, so the 350 became 15 cents. Okay, the 350 became 15 cents. So the 350 cost me 362 minus 15 cents. That means I lost 347 on that unit. And the 345 that paid me 510, that became 41 cents. Okay, so 510 minus 41 cents. That means I made 469 and I lost 347. So I made a total of 122. So what I'm going to do in this simulation, you may need to review the recording on if I went too fast with the math. So that is a net profit from those calls I rolled. Okay, 122. So I'm going to add this P&L to the 510, sorry, the 705 premium collected. So this plus 705, it's 827. So if I do this, and now I kill this one, and this one, and this one, and this one. So that would be the equivalent trade, which is a butterfly now, 280, 285, 290, 285, puts and calls, and the fill prices have taken into consideration the rolling of the calls, which I could not do with Thinkorswim, but I could do with a calculator as an estimation. So when I do that, you can see now the net P&L of the trade. Actually, the maximum risk is 154. It seems that I got filled at a little bit of a better price that we saw earlier. I noticed that Thinkorswim was getting a little bit better prices. I guess maybe the market was rallying a little bit and we got a better price. So great, 154 is the risk. So I'm just gonna copy the position to the clipboard and back to top. And we're gonna add this here. Okay, and with all those tweaks, so now we are in a P&L of 134 negative instead of 118. You may be like, how come it's worse? Well, because of course there is a bit of slippage built in the change that we've made. But even though temporarily today until time decay kicks in, we see a little bit worse of a P&L. Again, remember, worst case of this trade was like $300+ of risk, where this one now, worst case, is to lose 154, which is obviously a much better position. So, and we give the trade a second chance. So this is now the final part of the review of the trades, which I did as fast as I could, even though I did want to address, again, the move on Lulu was really challenging. And I'm not sure how many of you are in this trade or have been in this trade or are still in the trade, how many of you were able to act on time. But again, great example of what to do, even though because the market moves so aggressively fast, both last week and this week. So obviously there was a lot of traveling happening here, which I was not able to catch live with you because we meet on the Wednesdays or the Thursdays. And again, this move that took place yesterday, again, we were not meeting yesterday either, so I had to do the tweak now, which is way too late. Okay, so again, instead of 154, we'd have $100 of risk. Okay, so that's which is very proper. Anyway, so now we're gonna be looking for trades. I'll take a sip of water and we begin. If you have any question, comment, it would be great now if you could type it. If all is good, then let me know all is good. That's also important for me to know. Thank you, guys. So let's go for it. Okay, so we are now gonna look for opportunities to be bearish. Okay, so how do we do that? It's been a while that we have not done this. Okay, so I'm gonna put it on the screen, and hopefully it clicks. If you have any question, you let me know. We got 15 minutes. Okay, so I need to move. But if you have questions, please let me know. So first thing I want to do is I want to look for options that are cheap. So I'm gonna start with technique number 1, CIV mean less than 20. And also, I would like to find stocks that have a negative CIV spread. So if I go back to here, I'm going to be looking for top negative CIV spread, meaning that the implied volatility of the puts is above the implied volatility of the calls, which is a bearish sentiment. Okay? With those two initial scans selected, I don't need strength. I would also want to find stocks that are giving me some indication of strength to the downside, or maybe I should say weakness. So group weakness to the downside. I'm going to do midterm and long term. I'm just going to be demanding at first. Of course, if I demand too much, typically my list of stocks is going to be very short. So then I can always remove some of the check marks, but I'm going to start with being demanding. So I want those stocks to belong to groups that both on the midterm and the long term are showing weakness. I want to use my list of penny increment options. I don't want to have anything here which is strength of any sort. Earnings, yeah, next, I would say next than 30 days, so we have more time to get to a target. And also auto climate. So with auto climate, ideally, we'd have, again, being very perfectionist here, we'd like to have a weekly climate down, which is early, and we want to have a daily climate confirm down, which is early or sensible and close to the 9 EMA. I mean, that's a lot, and probably I'll get nothing. Indeed. Okay, so now it's time to start relaxing a bit. Okay, but before I relax my technicals, let's check at the implied volatility, because what I know for sure is that my implied volatility mean less than 20, that's going to give me very little results no matter what, because the VIX is not low. So let's look at it from the angle of implied volatility minus historic below 2 standard deviation. Let's see if I get something. No. And option number 3, what if I look at the top decrease on implied volatility mean? Still no. Okay, and again, I'm not surprised at all, okay, because I am being extremely demanding. So let's relax a little bit. I'm gonna uncheck the 9 EMA, click scan, and now I got one. Okay, so MasterCard seems to be meeting all of those conditions, but it's not too close to the EMA, which may be a problem or maybe not, depending on where it is. But to be honest, it's not that far. So actually, it's actually pretty okay as a setup. What's going on with the implied volatility? So we got implied volatility of calls and puts as an average to be exactly the same. I would certainly prefer to see the implied volatility of the puts to be above, but again, at least I got it on the S&P itself. On the S&P itself, the implied volatility for the puts is above, and here, since they're equal, I'm going to just choose to ignore it. Okay, if the implied volatility of the calls was above the implied volatility of the puts, then I would not contemplate MasterCard as a valid candidate, because obviously that would contradict the trade. But here it's just neutral, and because the S&P does have the gray line above the blue line, so then I'm going to be okay with that. Again, beginning part of the climate, getting close to the EMA. So let's take a look at the 55-minute time frame to see if we got UFOs and what's the probability. So the UFOs on the 55-minute time frame are only giving us 47%. So this is not acceptable. Okay, this is not. But what if we look at the 89? So 89-minute time frame, we need a minimum 50% to have some evidence that there is institutional interest. So 43% is worse. Okay, so that's not good. So what about 144? So I'm going up the time frames, if any, then I'm going to move down the time frames. 46, that's not good. What about the 233-minute time frame? Okay, it's loading. 44%. Okay, so that's not looking good. So what about if we look at the day time frame? The day time frame has UFOs right there. It's 50%. So then there is institutional interest in those time frames. What about the 2-day? The 2-day is giving us a 62%, and there is a super crazy big UFO there with 62% probability. So my friends, they are sellers. Okay, they are indeed sellers. It seems that the way that stock is being traded is that whatever orders are placed intraday, they are being canceled. That's what the statistics are basically revealing to us. So I guess that's the nature of the large market participants trading MasterCard. If they don't get filled in the day, they cancel their orders. But definitely in the daily time frame and above, those orders are kept, and there is institutional interest, and that's why we get those probabilities of 50% and above, as we saw. So happy to plan on a trade. The trade, I would like it to line up with 335. And again, if I move back to the daily time frame, 335 is indeed between 333 and 341. And 333, basically the current price of the stock is 333.00. So we are basically 56 cents away from the beginning of the UFO, from where the move can start. Okay, just for fun, we also have an Elliott wave turning point with a target located all the way down here in the purple area. So everything is looking pretty nice as a setup. The only thing that I'm not too happy about is the fact that it's MasterCard, meaning that the options on that stock are not the most liquid in the world. Okay, so we're gonna have to see how we're gonna handle this as I move into planning the trade in a moment. So targets. What should we expect if we cross this pivot line? Well, if we cross this relevant pivot, a price projection suggests price is going to come here, and on top of that we got a UFO. So I would say fair enough for us to set the target to be located around this price level at 301.75. Lower than that could happen, especially if I'm right on my analysis of the S&P. Probably we're going to go much lower, and even the weekly climate on that stock is early, right? So not only the daily is early, on top of that, the weekly is also early. So that stock may really push down very, very big. But at the same time, we cannot ignore the fact that this area is the end of an Elliott wave. And on top of that, there is a green UFO with 50% probability and a projection of a speed bump. So that area here is too strong to not to take profits. So we're going to set the target to be, let's call it 302. Okay, 302 is going to be our target. And with that target in mind, I'm going to right click to send to the strategy builder to see what the strategy builder is building for us. Okay, let's take a look. So let's sort based on return on investment. Okay, and it seems that a bear put spread is the best choice. Okay, a bear put spread is the best choice. Let me take a look. Again, I'm just a bit skeptical about certain liquidity parameters on that stock. Again, I traded this stock before, and I remember a case where I got a pretty bad slippage, so maybe I'm a bit oversensitive to it, but I just want to double check. So 13 to 14, that's $1. 15 to 16, $1. So yeah, so liquidity is not the best in the world, but it's definitely tradable. It's definitely tradable. Okay, now if we do the bear put spread, okay, notice how the performance is very similar. Okay, both if we do bear put as well as we do bear call, the performance is very similar, and the reason why it's very similar it's because the options are not too expensive and not too cheap, so the results are similar. Okay, now having said that, the risk of the trade vary. Some of those trades got a risk of 187, some of those trades got a risk of 352, 220. Okay, so there are certain differences with the risk parameters. So what you want to do when you use stop and you are doing this is that you may want to set your maximum risk. Okay, let's say you have a maximum risk of, let's say, $300. So you can now filter that, update. Okay, and now you are just left with the positions that makes the most sense. Okay, so you have a bear put and a bear call. Okay, the bear put seems to be a better candidate. Okay, so liquidity, well, actually, I'm going to go for the bear call. And again, we can see the spreads are a bit better on the bear call. But on top of that, not only that, we can see that there is more interest and volume compared to the bear put. Okay, so there is more trading happening here, and therefore we may get a better entry price. And since the difference in performance is pretty similar, we're going to make 187 or 192. It's about the same. So I'm just going to go with a bear call. Okay, so this is the trade I am going to consider for our trade. Now, let me tell you a bit more about this bear call. Okay, so this bear call is using the 330 and the 335 call. Now, the 330 call is slightly in the money. So again, this is a bear call, which is a credit spread, but this is a credit spread that is attempting to pick up direction as efficiently as possible. This is not a bear call, which we sell out of the money, hoping for the stock to never go there, like most applications of credit spreads that most traders, most options traders would do. Typically are those kind of like trades where, kind of like the iron condors, where you sell a bull put below, a bear call above, and you expect the stock, or you need the stock to stay, within the range so you don't get hurt. So many traders of options out there in the world, they do credit spreads with the same philosophy, but they only sell one side because they have a specific directional bias. Nothing wrong with that, but of course, if you are doing only one side, you get much less premium. Therefore, the reward to the ratio, it's typically much worse. In this case, we are not doing that. So we are not selling a better call spread, hoping for the price to not to go there. We are hoping for the price to actually fall. For this to profit properly, we need to be riding the move on the way down, okay? We could pick a different expiration date, certainly, but when we did the estimation, the strategy builder selected the target date to be June 18. Okay, that's the target date. So with that target date, it would be probably too tight to use the June expiration. Okay, even though it's at that time where it's almost there. Okay, the third Friday in June is what? Is June 17. Okay, so it's right there. Okay, so I'm with you. You know what? What about we compare? Okay, so if I copy the primary, but then I change June 15 and I do June 17. So yeah, to be honest, it looks much better. That's a good one. Very good one, Christian. The level of premium collected is very similar. Yeah. Liquidity is better too. Yes, so good one, my friend. We're gonna do this one, okay? So let's do this one. So this trade, the one with June, love the teamwork. The one with June is a trade with a risk of $240. Okay, so again, if this is too much for you, just do it in a Pepper Money account, or even if that's adequate for you, you decide the amount of contracts, and if you wanted real money, no real money, etc., or maybe you just simulate it on top, putting it on the positions panel, whatever your approach is, but know that the risk per contract would be 200 plus. Okay, so we're gonna go for this. Okay, and I'm just gonna use TOS for the execution. So MA. Okay, so we are looking at June 17. And we said we're going to do 335 and 330. So 335 and 330, producing a credit of 272. So I'm just going to place this order. Okay, just wait a little bit to see if we get filled. And in the meantime, I'll take this time to document the trade a little better. So we are entering this day at this price. Oh, I didn't. Okay, now I did. Okay, so we're entering this day at this price, okay, with a target located under this pivot low as a projection, which is basically 302 down here. Okay, so that's what we are trying to catch on this particular stock, and it seems that this vertical spread is going to be an ideal way to do that. So let's see if we get filled or not. At the moment, we have not been filled yet, so I'm just going to replace the order. Let me see if I get filled at 270. Okay, again, I'm just going to push it, given the time. I'll try to 65. And give yourself time to do these things properly with no rush, so you get good entry prices, guys. Don't push it the way I do. Okay, I'm going to do the ultimate push, market order. Please never do that. Okay, I just want to have it in the account, so that way we can evaluate this trade in the future. Okay, so it gave me 260 in the end. Okay, so that is 1485. Okay, so 1485. 12.25. Here we go, 216. So I'm going to copy this and place it on the positions panel. And we have it. Cool. Was this too fast? How did it go? How are you doing? Please talk to me. We are about to conclude the session. Actually, it's exactly the top of the hour, so it's time to say bye. Share with me, guys, how did it go today? Was it too fast, too slow, just right? Any comments? How is it going recently with your trading? Etc. etc. Jeff, you got 265. Very good, my friend. Great session. Very good. Thank you for that. Cool. So I guess you guys are probably busy doing the execution. Good. Same idea for Verizon. Not sure what you mean with same idea. With Verizon, what I was suggesting is to sell a call above the call you own. That was the idea. Did I understand you right, Mark? Please let me know. Okay, just waiting a moment. Yes, for Verizon, again, so with Verizon, you are long the 52.5 call. Okay, so the one thing you could consider doing is selling the 55 call. Well, with Verizon, we are expecting it to go up based on the group in which it is. Different story is that if the S&P goes down, then probably Verizon will go down too. Okay, but again, you already acted on Verizon closing the puts, removing the risk of the trade, isn't it? So in that sense, unless you have other things in your portfolio that contradict, so I think that you are pretty well positioned, because if the market goes up, and therefore this trade we just entered with MasterCard doesn't go well, well, now your Verizon trade may pay offsetting the problem. Where if you get rid of the Verizon trade and then MasterCard goes up, then you don't have anything hedging the MasterCard trade, or vice versa. Okay, so it all depends on what else you have in your portfolio for you to act on the trade or not. But definitely from an expectation point of view, Verizon is a bullish stock that belongs to a strong group. So, of course, if the S&P continues falling the way I described, based on what AutoClimate and everything else suggested, so then, yeah, you would expect Verizon really to rally to 52. Yeah, you wouldn't, okay? But getting rid of it, okay, getting rid of it may put you at a disadvantage in case we are wrong in other trades, like, for example, the one we added today with MasterCard. Got you. Okay. Christian Jose, scanner picks Pepsi as a short. Okay, great. Good to know. I would say that's going to be homework for you guys because the session is now over. But yeah, good. And also, I was very picky on the scanner. Okay, so when you look at the settings of AutoClimate, instead of early, you could have done sensible, and this may bring a few more. Not in this case. Also, when you look at stock filters, okay, maybe you are only focusing on the midterm or only the long term, and when you do that, this may bring in new symbols as well. So again, there are multiple things in different places you can touch, and now you got more opportunities showing up here, which are all still very picky, few at a time, right? You don't want a long list of stocks, you want very short, okay? And I like this. So now you have very few opportunities at a time, so you can go and find trades that potentially are of a pretty high quality, and then reconfirm the trade setup on the chart with the UFOs, the speed bumps, etc., and then you do your options play. Yes, Christian, why not? shorting SPY itself. Not a problem. I'm not a fan of ETFs, to be honest. To do that, I'd rather use futures or options on the S&P futures. But why not? Again, the problem is that your bet is one, right? So you are betting the market will fall. I prefer to have longs and shorts in my portfolio to offset my portfolio, and therefore I'm not a fan of shorting the SPY itself as an ETF. But you could, definitely, if the trade setup is suggesting it's time to short, which it is, and then you have the UFOs in the right place, you have the right probability, etc. So you could certainly do that. Okay, everybody, my friends, as always, it's been a pleasure. I will see you soon, which is, I believe, next week. And next week, I believe you'll have a couple of sessions with Josip and myself. So we'll see you then, my friends. You guys take care. Bye-bye.